Hi, I'm Stephanie Afrati.
And we're customer success managers at Wolters Kluwer. We'd like to introduce our wonderful experts who will be leading today's discussion. Ben Satterfield is a tax solutions specialist with over 4 decades of experience working with legal professionals, attorneys, CPAs, and Fortune 500 companies. Glenn Borst is a senior legal analyst who has worked in the legal publishing field since 1991 with a focus on federal tax law since 2001. He has written tax news and analytical materials for numerous legal and tax publications. Anne Gibson is a senior legal analyst who's worked in the tax field since 2010 with a focus on personal income tax, international reporting obligations, estate and gift tax, and estate planning. Now, we posted a link in the chat if you'd like to get to know more about our Wolters Kluwer experts. Also, everybody who is attending today's session will receive this recent strategic perspective on corporate AMT that Anne has authored. We'll also be monitoring the chat, so please feel free to submit any questions that you have. So we have a lot to cover, so I am going to turn this over to Anne to start our discussion. First, how do the tax changes in the corporate alternative minimum tax affect organizations?
Great. Well, thanks, Dana, and thanks for having me today. I'm excited to talk a little bit about this new corporate AMT, which was enacted as part of the Inflation Reduction Act. So the new corporate alternative minimum tax is sometimes referred to as the book AMT or book tax because it starts with financial statement income rather than the usual taxable income, and it imposes a minimum tax of 15%. So this tax is going to apply to companies reporting $1 billion or more on their financial statements, and it will go into effect for tax years beginning after December 31st, 2022. So a great place to get an overview of the corporate AMT, as well as quick access to the relevant code sections, is by heading on Vital Law to the Law Explanation and Analysis on the Inflation Reduction Act. This is just a great starting resource. Dana, if you wouldn't mind pulling that up for us, that would be great.
So let me just grab that. I'm in the federal tax dashboard, and here's the
Yeah, that's
Inflation
perfect.
Reduction Act.
That one right there. So what's great about this is it has an overview of the whole Inflation Reduction Act. And then if you go under explanations, just a little bit further down there, exactly, and open up that. Under corporations and business deductions, it has a section on the corporate AMT. This has a great summary, some very interesting background information, and then it goes through all the different sections and changes of the new law. And also there, a little bit further down in the contents, you have a section for the code. If you wouldn't mind opening that up, Dina, on the left a little bit. A
Would
little
you?
bit further over under the table of contents.
Oh, sorry.
Yeah, no problem. Yeah, so if you open that up, what's really cool there is it has all the code sections that were added or changed by the Inflation Reduction Act, and that includes all of the corporate AMT sections as well. So that's just a really useful way to have everything right on hand when you're working on this. So who exactly is going to be impacted by this tax? The book tax rules apply only to applicable corporations, which is defined in the code in section 59K. And applicable corporations are defined as C corporations that have over $1 billion in annual adjusted financial statement income. And this is another defined term that we're going to talk about in more detail in a little bit, averaged over the prior 3 years. And of course, there are some very important additional details, exceptions, and so on. I know the exceptions to these rules are one of the things we really wanted to talk about today. So a great way to see how these specific rules apply is by taking a look at another resource on Vital Law, the Applicable Corporations Decision Tree. So if you wouldn't mind pulling that up, it just makes it really easy to see how all these rules apply when you work through the tree. So this is great. You can find it here in Tax Essentials. Within the explanations, they have a link to this tree. And unfortunately, we don't really have enough time to walk through the whole thing. So I'll just focus on a few of the questions that highlight some of the exceptions to the applicable corporation rules. So to start with, the very first question off the bat is the corporation an S corporation, regulated investment company, or real estate investment trust? And the reason it's asking this is because these types of entities are excluded from the application of the corporate AMT. It just does not apply to them. It only applies to C corporations. So that's an important one to keep in mind. Now, another really important thing to point out here is that once a corporation meets the applicable corporation test, which, as we mentioned, that's having $1 billion in annual adjusted financial statement income averaged over the prior 3 years. Once it meets that test, it's going to stay an applicable corporation in future years, even if it falls below that $1 billion threshold, unless certain exceptions apply. So in general, once an applicable corporation, always an applicable corporation. But as I mentioned, there are these exceptions. So Dana, yeah, if you could click on that question there. This really gets at the heart of those. Has the corporation had a change of ownership or a specified number of consecutive tax years where it's fallen beneath the $1 billion threshold? Now, if either of these circumstances apply to a corporation that's already been determined to be an applicable corporation, the IRS can decide that that status is no longer applicable and remove it from applicable corporation status. However, there are some questions here. In the case of the change of ownership exception, what factors are going to impact the IRS's decision to remove applicable corporation status? Or in the case of the exception for falling beneath the threshold, how many years are we talking about? The code says a specified number of years, but it doesn't say what that is. These questions are meant to be answered in regulations, but no regulations have been issued yet. So until that happens, we don't have a lot of clarity on these exceptions. And so, of course, the release of these regulations is eagerly awaited. So thank you very much, Dana, for pulling up that tree. That's great. So our next step is to ask, how is the tax base determined? The tax base for the book tax, as I mentioned, starts with financial statement income, and the code sets out the particular types of financial statements that can be used in this context, and then a variety of adjustments are made in order to arrive at the taxable amount, which, as we said, is referred to as adjusted financial statement income. So Dana's pulled up this applicable section here. Yeah, if you could click on that, adjusted financial statement income right there. This section's great because it walks through all of the adjustments, and there are quite a few, and they're quite detailed. In the interest of time, I'm just going to highlight some of the most important adjustments that are going to apply to most corporations. So starting with financial statement income, you then add in a corporation's pro rata share of any income from controlled foreign corporations. And you also add in any income from disregarded entities of the corporation. And then you can reduce financial statement income by any taxes that are taken into account on the financial statements, as well as by any energy credits that are included in the new Inflation Reduction Act provisions. And my colleague Glenn is going to talk about these tax credits a bit more later on. The new law specifically excludes these credits from having any impact on a company's corporate AMT liability. Financial statement income is then also reduced by mortgage servicing contract income, income related to pension plans, and importantly, net operating losses. So NOLs can be deducted up to an amount equal to 80% of financial statement income. This was not part of the original bill for the corporate AMT, but made it into the final version and is a really big benefit for taxpayers. So how is the tax calculated? Once we have the financial statement income determined, calculating the tax is relatively simple. The rate of 15% is applied to adjusted financial statement income, and then any corporate AMT foreign tax credits are subtracted. So this resulting amount is the tentative alternative minimum tax. If the tentative alternative minimum tax is more than the amount the corporation would owe under the normal corporate tax rules, plus the base erosion and anti-abuse tax, then the corporation must pay the higher amount. Technically, the corporation pays the two standard taxes and then the amount by which the alternative minimum tax exceeds them. So corporations can then offset this combined regular and minimum tax liability with general business credits, including the research and development credit. And again, this was something not included in the original version of the bill, but that was added later and is a really big benefit for taxpayers. So that is the summary of the corporate AMT as enacted by the Inflation Reduction Act. But before we move on to our next speaker, I just wanted to note that any corporation that's going to be affected by this corporate AMT is almost certainly also going to be impacted by the OECD's proposed global minimum tax, known as Pillar 2. This is a multi-jurisdictional minimum tax that will apply very broadly. At this point, over 135 jurisdictions have already agreed to implement it. Negotiations are ongoing, and each country is going to have to implement its own domestic rules to put this into effect. So the exact start date is not yet known, but it is hoped that it will go into effect within the next few years. So more details are going to be available in that strategic perspectives that Dana mentioned that you'll all receive at the end of the session. So I just recommend reviewing that, as it will likely impact any taxpayer that's also affected by the corporate AMT. All right, so now I'll turn it over to Ben, who's going to talk about how you can easily identify federal tax statutory changes with some of the tools we have available.
Thanks, Anne. As we have reviewed, the IRA is amended, repealed, and even added some code sections. The law explanation and analysis that Anne went over provides some pretty deep insights. Combined with tax essentials and those decision trees, we're able to see insights on the CAMT, some changes in individual and business credits, healthcare, and excise tax. But the question arises is, how do we actually see what's happened within the statute and how the actual language of the law has changed? So within Vital Law, we offer the Standard Fed Plus, which is really our archived standard federal tax reporter that allows us to see the code over time, all the way really back to 1917. So within the Standard Fed Plus, we're able to identify exact changes based on the time frame that we input to the software. So in this case, we know code section 59K is one of those sections that we identified through the actual law explanation and analysis, that section that we looked at within Anne's presentation. And we realized that, hey, this code section has been impacted by the IRA and what exactly has happened. So at the top of the screen, you'll see this really nice, nifty timeline where we allow users to input the dates they want to see. And you'll notice that it looks like October 16th was when we actually had this update within the product. So when we talk about real-time updating, it typically takes our editors a few weeks to kind of see how this is related to the actual statutes. And then we actually work with the software to provide updates. And what you'll see in this example is all of this green line language has been added. This simply takes either keyword searching, you simply put in the code section that you're interested in, or you can go click throughs within the standard federal tax reporter into the specific code section. And as we know, as Anne pointed out, there's not much, if any, regulation at this point with the IRA. When those regulations come out, we'll also allow you to see what new regulations have come out within this product, as well as you can actually pick the document types that you want to see and be alerted via email whenever there are updates on particular code sections that you're interested in. So when we talk about real-time updating within the statutes and within the Standard Fed Plus product, that is exactly what we can do. So we wanted to point that out in relation to the law explanation that we publish, the workflow tools, the decision trees, and the Standard Fed Plus on the back end of that allows us to actually see the language of the law and specifically what code sections and what the actual change has been within that language. So that being said, I did want to turn this over to Mr. Glenn, who is going to discuss the impacts of the IRA specifically to ESG and kind of dive into that subject matter now. Thanks, Glenn.
Thank you, Ben. One important area addressed by the Inflation Reduction Act, or IRA as we've been calling it, is ESG, or Environmental, Social, and Governance. The IRA provides a number of opportunities for organizations to meet their ESG goals in a cost-effective manner. The IRA also provides opportunities for clean energy project developers and manufacturers of clean energy equipment to reduce their costs and grow their businesses. This results largely from the IRA's combination of clean energy and manufacturing tax credits and new or expanded grant opportunities. These credits and grants help organizations to lower the cost of meeting sustainability goals and becoming energy efficient. So, what is ESG? ESG stands for Environmental, Social, and Governance concerns. ESG investing, generally speaking, is any investing that takes into account non-economic factors as well as economic ones. And how does the IRA affect ESG concerns? The IRA provides a number of important opportunities, including extension of investment and production tax credits, credits for new technologies, and enhanced credits based on use of American-made materials, among other measures. The IRA also creates opportunities for exempt entities to benefit from tax credits. The new law creates a number of environmentally related funding, grant, and loan opportunities. Okay, in Vital Law, you can find important material on ESG. For example, searching for ESG, and we're searching here from the federal dashboard, searching for ESG yields over 100 sources that expand on the nature of ESG and how it relates to compliance and tax practice generally, including the relevance of the IRA to ESG concerns. The first search result here indicates that the Government Plans Answer Book answers questions related to ESG following passage of the IRA. The 10th search result lists insights by PricewaterhouseCoopers on ESG and the Inflation Reduction Act. And the 12th result is an article that expands on areas related to ESG-related developments due to the IRA. Over 100 other articles, insights, and publications focus on dealing with ESG. This includes Wolters Kluwer's Law Explanation and Analysis discussion of the new law, which we've already looked at. If you look in the explanation section of the LEA, you can see that there are a number of different sections, and two of them are the individual and the business credits. And there are a whole bunch of them listed there, and almost all of those pertain to ESG. That is a major focus of the legislation nowadays because the environment is such a major concern. So ESG is a vital area of concern for firms nowadays, and Vital Law provides answers to the various questions that may arise in this area. And I would add that if you search from the all content dashboard, you get over 400 results. So that shows the relevance of ESG to other areas outside of tax. And thank you, and back to you, Dana.
So thank you, everyone, for your insights and your knowledge. I know I learned a lot, and I hope everyone else did too. So we've got just a bit more time, and it looks like there was a question. So one of the questions that came up is, what is the purpose of the corporate AMT tax, and what is the issue that it's addressing?
Okay, great. Yeah, I'd be happy to answer that. That's a really good question. So, the stated goal of the corporate AMT is to ensure that large U.S. corporations are paying an acceptable amount of tax. So why is this even an issue? Our current corporate tax rate is 21%. Well, despite that, companies can come to owe no tax, even if they're making a large profit, through a number of mechanisms. This could be by using like existing tax deductions and credits to such an extent that their tax liability is very low or zero. And although lawmakers, of course, chose to put these deductions and credits in place, and the companies are using them lawfully, the legislators or maybe their constituents might be unhappy with the result. So that's kind of where we're at the moment. And some people ask, well, why not just fix the code if it's not working the way that we want it to? That can actually be really difficult, I think, as we've seen with past attempts to reform the tax code. And in many cases, it can actually be a lot easier to do something like this, to impose an alternative minimum tax, basically set a minimum tax rate that's lower on a broader tax base without having to revisit these popular tax deductions and credits that can be really difficult to repeal.
And then, thank you. Just a quick follow-up though.
Sure.
Are there concerns though in how that tax base is determined?
Yes, for sure. There are some concerns. So, using financial statement income rather than taxable income is pretty unusual. And the determination of that financial statement income is governed by the GAAP rules, the generally accepted accounting principles, which are themselves set by the organization FASB, Financial Accounting Standards Board. And obviously their goals are totally different. Their focus is on setting accounting and reporting standards that are fair and accurate. And they've actually publicly stated they're really not interested in getting involved in questions of tax policy. And so some people really wonder about the wisdom of having the determination of these rules that's going to affect this new tax base in the hands of this non-elected, non-tax related body. And in particular, some people have been really worried about the potential for lobbyists and others to put pressure on FASB to change the rules in ways that might impact this new corporate AMT.
Well, thank you. And Stephanie, are there any other questions that have come through?
There are no questions that I've seen.
Okay, well, thank you again, everyone. We really appreciate our expert speakers for their time, and thank you all for attending this session. We will be following up and sending the link to the recording, as well as providing everyone the strategic perspective document on corporate AMT. So thank you again, everybody.
Thank you.
Thank you.
Thank you, everyone.
Everyone.
Thank you.